All right, this week started off with some fireworks that actually occurred before we all woke up. But then the rest of the week was kind of a dud. We finished the week strong, good bullish week. The problem is all that bullishness occurred while nobody was watching. And then the rest of the week during the regular trading sessions, we were flat as a pancake. But we kind of started the week with this idea that we're breaking out and we need to either solidify this breakout or we've got this risk to the downside with those gaps that we can fill in. So that's kind of how we started the week, and that's still, after 4 more days, how we're finishing the week. So, but there's a good chance that we can break out next week with the same risk of those downside gaps to the downside. So I'm going to break down what are those signs that show us that, we can really get going here and break out to the upside. How that influences my expectations in the short term, and then also in the intermediate to long term from there. What kind of market we might be in here for a while and where we can take advantage of it. Today's trade idea is going to be a little bit different from norm in that we're looking at a stock that had been bullish but has reversed its own course. So how can we take advantage of its short-term weakness kind of on a small scale as an example of what could happen here on a larger scale? So let's go ahead and get started. Today is Friday, May the 22nd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. We finished the week really flat, after starting off the week with a gap to the upside. So opening up here at 29.1386. On Monday, we finished at 29.55. So most of this week's gains again occurred Sunday night, early Monday morning, and then the rest of the week we just kind of, especially after the close here on Monday, we didn't go anywhere the rest of the week. Up and down, and flat to finish, bringing the near-term line down below 50. Okay, are we going to set up here? Are we going to, we have a decent chance now to bounce off of here and then make a new near-term run to the upside. This would be it would be a higher near-term low point. It wouldn't be very much of a dip, but it would be a higher near-term low point. We'd have we already have a strong bullish posture. We have rising long-term market sentiment that's close to crossing up above 50. This would set us up for a really good rally from here. The potential for a breakout. Now, I think that's not a higher probability scenario. I think our higher probability scenario remains filling in this gap from Monday, because it's more of a common gap there, especially with the extreme lows that we've been getting on the momentum line, and not any extreme high, or not even overbought highs on the to the upside on the red line. But it is a scenario. It is something that we need to. While it is low probability, it's lower probability. It's not 0% probability. So there is a chance that we can come out of the holiday weekend here on Tuesday and really kind of take off here to the upside. If you take a look, the Dow looks very similar. The NASDAQ, interestingly enough, also looks very similar, even though it had a better close. In fact, you notice it got above the 78% Fibonacci retracement and has stayed up there. That's a very good sign in terms of trend reversal. I talked about the retracement zone between these 23 and 78% areas, that you don't get a retracement until you break into that zone. And then you've got the resistance in this area here, kind of this big block of resistance at the Fibonacci retracement area. So once you get into this, you start retracing. You got some resistance all the way up here, and we kind of held there for a little bit, and then we broke in, held the top of it for a little bit, then we broke out of that, and now we're kind of in this sucker zone where we're not bearish anymore, but we're also not quite bullish yet. Not bullish enough to get a new trend going. Not until you break the 78% level, which is what we have done. We've broken through that now, and so that's why there's a good signs that the NASDAQ can lead us up on a nice trend. Now, we've talked ad nauseum about the outperformance of the NASDAQ relative to the Russell, and that's gone parabolic. And that's okay. We don't know how long it can stay parabolic. We saw in the late 90s, a move like that can stay parabolic for months before it starts to peak. And it's been moving higher. It started to go parabolic at the beginning of the year, and it started, even during the pullback, it started to increase. Very similar to that 98 pullback there. The Russell 2000 unfortunately, has not quite been as bullish. It hasn't broken through the 62% like the S&P. It hasn't broken through the 78 like the Nasdaq. It's still stuck right in the middle of this retracement zone. We have broken out of this little channel, so that's a good sign. And you're flirting with this 50%, but we still can't quite get above that high yet. The near-term line, unlike all the rest of these, where the near-term line is pulled back because of how sideways we were, we've been more bullish on the small cap. In fact, over the last like 5-6 days, going into yesterday when I looked at the comparison of the Nasdaq to the Russell 2000, the Russell had outpaced the Nasdaq by double the returns going into yesterday's close. So a little bit of an underperformance today. You can see over here the small cap index. Well, by the end of the day, the small cap index ended up just a little bit higher then. So if I were to show you that chart, there's a chart I'm talking about. So Friday, going into Friday, the Russell outperformed on Friday, and then over the weekend, and then by the end of this week, you can see we finished 10% higher from Thursday's close of last week, whereas the Nasdaq has only finished less than 5%, so more than double the returns. So a really good run here lately. That's reflecting in a more bullish market forecast chart. For at least in the near term. So the near term line is still higher. Its market sentiment line, however, is the lowest. So it's still got some room to catch up, obviously, not being able to 50% retracement very much yet. And, it's still got some room to catch up. Remember, this is more reflective of the broader economy. So as long as the broader economy stays a little beaten up, then the Russell will continue to be beaten up. That's why, the Qs, which are not representative of the broader economy, it can keep going up. And keep going up and keep going up while this maintains some outperformance. So we'll kind of keep our eyes on this, and but the most important thing is what we see here, and that can lead us, that can lead the broader market here through its own resistance and pass and establish its own trend. Alright, so before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this subscribe button right here in the bottom right corner of your screen. There'll be a red button that pops out. Click on that. There's also a red subscribe button down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again on Monday. It's a quick survey. We take a look and see what you're thinking about our videos. If you like us to do the videos, let us know. If you don't like it, you don't have to click on anything. Also, while you're down there, comment. What did you get out of our videos today? Any questions or comments, post those down in the comment section below. Love to see what you're thinking. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page to subscribe to our site for free. Follow me on Twitter at DavidSettle42 for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching this on our blog, we invite you to check out some of these things here on the right, including our Market Outlook Live trade review videos that we do. I already did one today here at 3:30 Eastern Time. We do these videos on the days I do the Market Outlook videos, so Monday, Wednesday, and Fridays. You can check out, we review all the old trade ideas. We closed out another one today, and we also put on today's trade idea before the market closed. So you can check those out there, as well as all of our classes here. All of these are part of our monthly subscription plan that you can check out with this information right up here. At the top, you can see the two different plans that we offer, and if you click on the word pricing here, you can see a comparison of the two, what you get with them. We also invite you to engage with us here on social media. Click this heart. It opens up this window. Hit that like button. Hit that thumbs up. Takes you to a new tab. Like today's Market Outlook Facebook post there. Again, that benefits us because the more likes these posts have, the more they will promote our content to all of our followers because of the engagement involved. It also benefits you because they promote content in your timeline from the accounts that you follow the most or engage with the most. We try to make it really easy for you to engage with us here. All right, let's get back to the charts here, and let's take a look at the long-term chart and how we finished the week. So we finished here at 2940.87. And the highs were 2945, 2954, so not quite closing above these three high points. If you take a look at, again, the QQQ, and you can see we have closed. In fact, it's closed above all, they weren't the same. We've been gradually getting higher and higher and higher there. You look at the Russell 2000, and it wasn't nearly as close, so it had pulled back, but still a higher high, a higher close, no lower shadow. That's a bullish Heikin-Ashi candle, and when you get one, you expect to get more, because that's how this candle worked, right? We close at 29.55, and you notice that next week's candle will probably open up about 28.95. So we're going to open up well above. We're going to open the week next week, depending upon how we do Sunday night, so we don't get any kind of reversal like we did last Monday, the reversal of what we got last Monday. We're going to open the week with a pretty strong move to the upside, and that's going to be a pretty decent bullish candle. The question is, will we go up to a higher high? So that would be higher than 29.80. We're at 29.55, so there's a good chance. Are we going to be able to avoid getting a lower shadow? Well, we'd have to dip below 28.95, and we're further away from that, so there's a good chance, right? And obviously, we'll see. We'll see once things open up on Tuesday, but that's kind of, it's a good, it wasn't the most bullish candle like it was on the Qs, but it was a pretty decently bullish candle for the S&P. And again, flirting with that 200-day moving average. So that's the important thing here. We closed above it. Now the question is, are we just going to flirt with it and reverse next week? And for that matter, if we did reverse next week, very good chance we get back below the 50-day moving average. So are we going to reverse next week, or are we going to break on through? And again, the QQQ, we flirted with it that first week, and we busted right on through the Fibonacci levels and everything. The Russell, we've got a little bit of room before we even get to that 200. So if we do get up to the 200 on this, it will be because the S&P has broken through. So there's a good, that's kind of what we have. We're still kind of at this limit. We're still at this 62% retracement level. So we're flirting with a breakout. Now we need to solidify the breakout and be bullish, because we'll either do that next week or we won't. All right, these ceilings will hold. And from what the NASDAQ's telling us, then we have a good chance that we'll break through. And that's kind of what you can lean towards, is that direction. But we need to be aware of the possibility of when we flirt and we don't solidify, it's basically a reversal. So we need to keep that in mind, especially also considering that we're still at the 62% level there. Let's take a look at some of these other oscillators, starting off with the 3 green arrow chart. We do have the 3 green arrows. The MACD is above its moving average. Stochastics is in the reversal zone. We're above an 8-day moving average. We're pulling back a little, but we're still above the 8-day moving average, easily above the 17 and the 30. They are a little close to each other. But here's the issue, like the RSI, we still can't get above 60, right? The DMI, we still can't get above the positive directional index. We still can't get above 30, and the negative still not dropping below 20. You take a look at the Bollinger Bands, and we are in the upper half, and we're flirting with this now 294. Because we have this volume here now, the point of control is right here. It was at the 300 level, so you can kind of see we're pretty much at the point of control area. We're at this limit, but at least we're in an upper range of this Bollinger Band chart here. If you take a look at the trend strength indicator, we are flirting with breaking above 5 and 80. So good sign there. We're above the Tenkan line, the green line. So, we have a lot of bullish indications. We just don't have them all yet to say, all right, here we go. We are, like for example, to get that kind of move here, after a month of recovering off the intermediate low point, are we set for another extended long run? And we're not quite to that point yet. So again, we are on the Qs, so that's a sign that we could be on the S&P eventually too, and we're obviously not nearly as close on the Russell quite yet. And let's take a look at the intraday chart for the S&P 500, and you can see again, we broke up above, and this is great, but then we've just gone sideways ever since. So we started to fill in this gap here, and you can see where my horizontal line is to the right. Today, you notice we haven't quite finished filling in that gap. We filled in more than half of it, but not quite all of it. And we've only dipped our toe on that one. So these two gaps still loom heading into next week. And that's why in the short term, unless we solidify this breakout, in the short term, these two things will be looming as weakness. So we need to really kind of break out above this 300 area. Break out. Remember, the point of control here on the 4-week chart is pretty much the same spot it is on the daily chart. So, if we can break out above this point of control and get on the other side of it, like the Qs, and here we go. The Russell obviously is going to be a little bit longer for something like that to happen. The range today, very, very minimal. It's a holiday. We are 2.5 points. No gap. Like we filled in a very, very small gap. So 2.5 points, 63 million. This was a holiday. We're already back down to 63 million. That's the volume levels we were at over here. But it's pretty crazy how quickly things can get right back to where it was, right? If you take a look at where the volume 63 million is way down here. The trading range of 2.5 points is way down here. We're on our way. We're on our way to busting through. Now, remember here, for the trend to get established, we need to be below 1%. So we're still a long ways away from that. So any breakout we get is still going to be relatively more volatile compared to what we're used to with bullish trends, where we just grind up and we never go down, right? So there's still going to be some ups and downs because of how high the ATR is, as well as how high the VIX is, right? The VIX, again, dipping its toe below 90%. Before, that was a signal that something like that was coming. So we need to keep, as flat, as bullish as we were this week, and we dropped initially. We haven't really dropped any more. And the fact, like I said, that we are dipping our toe below 90, we've seen this story before, and that led us into some, a move back up to 100%. So we either flirt with this, we either solidify that move to the downside, or we flirt with getting below it, and then it really turns against us, right, and makes a move, like I said, back up to the 105% area. And I don't think we're going to go beyond, but back into this area is something to keep an eye on, unless we solidify that breakdown in volatility. Interestingly, we kind of started this week at an inflection point. We had made a significant move, semi-breakout move to the upside, and we talked about solidifying the breakout and really holding it and pushing it up or not. And all week long, we stayed there. So after Monday's close, Tuesday, Wednesday, Thursday, now today, we haven't done either one. We haven't started filling in any of these gaps on Monday or Tuesday, Monday or Wednesday, but we also haven't broken up either and really solidified the breakout. So we're stuck heading into a holiday weekend. We're kind of stuck here. Mainly because, in my opinion, because so much of this week's move occurred overnight on Monday morning, or Sunday night and Monday morning. Because so much of this week's occurred there we didn't have the momentum of volume to push us up all week long to where we can really solidify a breakout move. It's hard to solidify a move that occurred on extremely light volume. Right, and so that's why the volume tapered off this week. That's why we haven't gone anywhere this week. Now, we're not bearish enough to pull back, but we're also not enough volume yet. So, if this near-term rally does take place next week and that near-term line takes off, again, ideally it occurs during the regular trading session. So that momentum, and even if it's just regular volume during a regular trading session, can take us up and keep us up. And solidify this breakout, and here we go, and led higher by the Qs. If not, then we're at a ceiling, and to go from ceiling to floor is not going to change anything. It's not going to change the trend. It might delay a bullish trend from developing, but it's not going to change us to a bearish trend. If we go from ceiling to floor, then we've done it a couple of times in the past few weeks. There's a good chance we can do it again next week. So that's the inflection point we started off the week with on Monday, and because we haven't gone anywhere, that's still the inflection point that we go into next Monday with. And I expect eventually we'll get this bullish move, right, that the Qs are leading us through. But in the very short term, I still expect gaps to fill and the ceiling to hold until we get more of a regular move, a regular trading session move, to the upside that can break us through here and then keep on going. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. Hit either agree or disagree. If you click disagree, comment down below as to why. Why are you, why are you a lot more bullish than I am right now? Why are you more bearish than I am? All right, now let's dive into the price action for the week. And let's start off by taking a look. Like I said, I'm going to go back to that last Thursday where we kind of gapped down, then we rallied, or last Friday, excuse me. So I'm going to come over here, go to this Friday move, and then take a look at how things have performed. Like I said, small caps really killed QQQ, and obviously much even better than the S&P. And really big move in crude oil in the USO ETF. Crude oil continues to make a strong move to the upside. And you can see small losses, not very much in yield, in bonds, gold, and the dollar. Let's take a look at some of their charts. Let's start off by taking a look at crude oil. And you can see the strong bullish posture we have. A little bit of a long lower shadow today, and we'll see how that plays out. But we did get a cluster on this entry of the intermediate line when it gets above 80 here. If it can cluster two at the same time, great. That usually means we have a strong intermediate run coming, and that would be a very, very good sign from a broad risk appetite standpoint. You can see there's resistance in this area. If I look at the Bollinger Bands here and we pull up the futures contracts, there's a little bit of resistance, not very much of one, but if we break through here, then we're moving up really rapidly because there's no resistance at all. So we'll kind of keep our eyes on that. You can see, again, that 75% mark is a really important mark to stay up above. So if we can stay up above that, great. Get into the upper half of the Bollinger Band, that's a good trend. Otherwise, it's kind of, it's a little bit of weakness to keep an eye on there for crude. Let's take a look at the long-term charts now for some of these other assets like the 10-year yield. So long upper shadows, we got some bullish candles. It looks like it's trying to reverse. It's trying to get up above this 50-day moving average. It flirted with it this week before falling back down. That's going to be a very, very important level for us to get through. Let me show you what it looks like on here, but with the ETF. Well, this isn't exactly, this is more the ETF that tracks it. But IEF. So you can see if IEF were to break down, and it's really squeezing here. If you take a look at the Bollinger Bands relative to the Keltners aren't very wide either, but we've really been squeezing for a while now. The Bollinger Bands have really gone sideways inside of the Keltner channel. So there's a breakout, according to this, there's a breakout coming. And if it's a breakout to the downside, then that means you have a pretty decent move to the upside on yields. And if it breaks above the 50, there's such a wide gap between the 50 and the 200-day moving average that, risk, from a risk appetite standpoint, that's a chance for us to really make a move, right? And so your downward move here would be coming down at least to 115, if not down closer to this volume node at 114. That would be a sign that we got an S&P breakout, and the breakout solidified, and Qs are probably going to be leading that, and that's okay. And here we go, right? Here we go to the upside. So you can kind of see how this inflection point is there in other asset classes too. Here's gold. Now gold has been kind of it's still been in the bullish trend, but you notice not nearly as bullish. A little bit of a bullish run there, but its bullishness is starting to slow down a little bit. If you take a look at here, let's actually look at the futures contract. There is the trend now has gone to where it's noisy. So we don't have a strong trend going anymore. We're not above 5 here. So it's lost its trend. Now it's also a little bit of an ascending triangle where you've got some lows that have been progressively getting smaller, and you've got these highs right around 1750, maybe 1760 in this area. If you get above that, then there's a chance that we can really get going. But if it reverses, then another sign, and you can see there's a pretty decent gap between the 50 and the 200-day moving average. If it were to reverse and give us a reversal candle, you see next week's candle is going to open up about 1733. We're trading at 1734. So next week's candle has a very good chance of being a reversal candle. for gold. That would be another sign of risk appetite taking off and breaking out beyond just what we're seeing in the Qs, right? And of course, here's the dollar index, and this is a really, really important one to watch. And I've been showing you DXY. DXY is essentially the euro just flipped in reverse, and if the euro has been trying to figure this out, right? It's been very volatile, and it's got a lot of upper and lower shadows. There's not a trend here. Once a trend develops, and if it's a trend to the upside, which is what you'd expect because of the pullback, if it's a reversal and a trend to the upside, and here's the longer term view for it. And let me go to a monthly candle. We still got a week left in the month, but if we end up getting some, reversal to the upside in the monthly candles, see next month's candle is going to open up right about 109.50, and we're trading at a little bit above 10. We're pretty much trading right at 109. So we have a chance of getting a reversal candle next month. And again, bullish move here would also be another indication of a breakout in risk appetite, broad breakout and risk appetite, and a chance for us to move and get moving here. Let's take a look at the charts. I want to show you the foreign markets. Oops, not this one. I want to take a look at the 12 grid. And you can see we're getting more dark green shadings and green lines again. So, China, a little bit of a reversal. They have their own issues going on right now. So it's actually not the greatest, right? Light pink shading, and we actually have a red line here. South Korea is also kind of following in sympathy with that. But most everything else, even these European areas that have been lagging behind, are showing dark green shadings and green lines. So before, in 2019, when we had the broad-based breakout that really solidified that October move, and we got going all the way until this January of this year, it was, there was a lot of dark green shading here, and that's what we want to see, a broad increase in risk appetite. And so it's good to see that we're kind of starting to see that even with a couple of light pinks, they're still above 50, so they can turn to dark green pretty quickly if they were to bounce. And that would be very bullish. We don't want this to be a U.S. story. We've seen that. That's 2018 and first half of 2019. It was pretty much a U.S. only story, and it was good for U.S. stocks. It wasn't good for all risk appetite. And if risk appetite all gets going here broadly, then it's got a better chance of making a similar move like we saw in 98, 99, where we had a good 18-month run to the upside. We want this to be more than just a 1 or 2 month run. And then we just continue to consolidate and grind and go sideways in a volatile range. From a sector standpoint, lots of dark green shading and lots of green lines here too. You can see technology, discretionary, communication services leading the way higher. That's what you'd expect to see. Financials and industrials are more indicative of the broader economy. They're not so much going up, and financials really are going to struggle until yields go. They're really going to struggle. So keep an eye on yields for that sector. And then you have your safe havens, which are weaker, and so that's not surprising either. You would, and they don't have to. We don't need them in downtrends, but we do want them to lag. Even in a lot of 2018 and 19, they were the leadership during a lot of that bullish run. And we don't want them to be leadership. We want these areas. These are your QQQ stocks up in these three sectors at the top. And ideally, we kind of want to see financials and industrials kind of get dragged along eventually with it. And materials and energy can take the baton last, right? That's the lagging sectors. They tend to take the lead late. So eventually, we can let them lead. Materials is kind of getting a little bit of some relative strength compared to some of these sectors. So it's kind of making a little bit of a run here lately. Like I said, just in relative strength alone, only down 10% versus 26, 21, 25 in some of these other areas. So it's not as bullish as these other three, but it's not as, it's looking a lot better than some of these others as well. Really, even utilities and real estate in the last 3 months, are down, like 20%. That's like bear market mode still, despite the bounce off of these March 23rd lows. All right, I showed you this same time frame, so this includes last Friday and then all of this week. You can see what what's led this week. Interestingly enough, industrials has joined the party with discretionary communication services, technology lagging a little bit, financial still lagging, unfortunately, but that's going to be the case unless yields take off. And like I said, materials had a good week, so they're kind of catching up here a little, along with energy. A little bit of weakness in the dollar helping to propel those two sectors up to beating the market. On the flip side, your safe havens lagging, in this case, healthcare as well. Remember, healthcare's got kind of the growth element and the non-discretionary element. The growth element's tied to this drugs and the vaccine and things, and biotech. That's more of the QQQ type element of it. There's also the element of the non-discretionary, the hospitals, the insurance, and that hasn't been as good. And so you can see it's not surprising that it would behave. It's at least that element, which has been kind of like buy the rumor, sell the news in terms of getting this vaccine, but also in terms of like all the rest, like in terms of hospitals laying people off and not functioning at full capacity, and generating the profits that they normally would outside of a coronavirus epidemic. And that's putting some pressure on them. So remember, they were big winners. So it's a little profit taking here. Even utilities and staples heading into that peak this year, they've had good years too. So, if I were to go back like, a few years here, let's go back a couple of years, utilities and real estate and staples were all doing really, really well. So they've had good returns. In fact, if I were to go back to January the 26th of 2018, so from that peak till now, like I said, technology had a good run here to catch up, but for the most part, utilities and real estate and then staples were outperformers for a long time. Now even with the pullback and their relative underperformance, they are still outperforming to a degree the broader market and all these other cyclical areas down here. And you can see why energy materials, while they're doing so well, they've got a lot of room to run to catch up. And so do financials and industrials. And look at technology just lapping the field now, during the rally and the pullback and the subsequent rally, really just lapping the field well up above, 41% up above that January 26th peak, whereas the broad market itself is only 4%. And a lot of these areas, at the other top sector, that's cyclical, the discretionary is up 12%. You still have financials still down 27% from that high. You still have industrials and materials roughly 20% down from that high, and energy stocks half of what they were. So, you still got some pretty significant bear markets here, even if it doesn't look like we're in a bear market because of QQQ. All right, that leads us to our trade idea of the day, and it's actually in a stock that's had a bullish run, but a little bit of a rollover here, and that's Roku. Roku, we had light pink shading and yellow line, but today, instead of bouncing up, we're breaking down. Now, we don't have dark pink shading yet, but it's close to like we will. The short, you see we got a bearish near-term high point there, coming off this bearish near-term low that we had. So you can see the near-term sentiment has changed, and it's leading towards more of a bearish sentiment in the stock itself. If you take a look at its three green arrows, the MACD is negative. Stochastics is in the reversal zone, so is the moving average for the stochastics. The MACD's moving average is close to crossing zero. Both the 8 and the 17-day moving averages are crossed below the 30. If you take a look at its long-term chart here, Roku, there we go. You can see we're back below the 200-day moving average. So again, we get to this point where we break out and we want to hold this, but as of right now, not only have we not held it, but we're back below the 50-day moving average, and we're still in death cross environment. This is what we do not want to see on the broader market picture. If you take a look at some of these other oscillators, like the Bollinger Bands, we got up to the point of control, we got up to this significant resistance, and we fell down. And we're kind of falling through now into the lower half of the bandwidth. Really bearish territory here. You look at its RSI and CCI, and you have to keep an eye on that 40 level for a bearish drop, as well as getting below negative 200 so that there could be a pretty significant move coming up next week to solidify this breakdown in this case. And then you also have like the DMI, which is also setting up for that same type move. We're above 25, we're dropping below, close to dropping below 20. You know, when remember the biggest move on these, you know, this is kind of the rare where we start off really skinny and then we blow up at the end. Usually we blow up at the beginning and then we skinny up by the end of the move. So, you know, if we're going to get this type of move where the pink line jumps up above 40 and the blue line falls below 10, you know, we might be setting we might be setting ourselves up for something like that. Something like we didn't quite get there on this move, but this type of move over here, we might be setting up for that type of move starting this downward trend. So we'll see. We have the trade that we set up because you know there's some support down here and you know the market itself is still strongly bullish. We don't want to be too aggressively bearish. So what we did here is we bought the 120 call, or sold the 118 call and bought the 120 call. So a short call vertical spread up above where we're at, where that volume node is, right? So there it is. It's a short call vertical spread. The idea behind this trade is to, you know, we're not position sizing into the full position size because the spreads are really wide. So you have to keep that in mind in terms of liquidity. Will I be able to get out? Will I be able to avoid a big loss if it were to take off to the upside? So position sizing with about 3/4 of a normal position size, because I don't have to worry about earnings, and there is a lot of good bearish breakdown signals. And then you can see going for the $250 reward for that risk, so about 1/3. You know, going about 33% risk there, which is typical when you're setting up a short call, a high probability short call vertical spread. If we can get, you know, 125 really quickly, which I doubt because we're almost to June, we're almost to 20 days out anyway. But if we can get it quickly, otherwise we'll just shoot for that $250, and then on the upside we'll take a $250 loss if it really were to take off. And you can see it would really have to take off to get up to that $250 loss level where I would get out of this trade. So a good chance that we can avoid, you know, a full $750 loss in the worst case scenario. All right, you've heard from me now. Now I want to hear from you. Use that link up there in the top right corner of your screen. If you have any questions or comments, post a new thread there, reply to anybody else's thread, and let's keep this conversation going here over the weekend. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Follow me for more content at DavidSettle42 on Twitter, and join our Facebook group as well as our community at marketscholars.com. Have a great rest of your holiday weekend, everybody, and we'll see you all on Tuesday.